Today, our latest perspective on the finance, housing and mortgage industries. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I took part in a virtual seminar for an investment bank, and this is an edited version of my session in which I looked at the mortgage industry from our data perspective and also some of the broader industry issues and themes that we've been exploring, which again are informed by our research. It was a really good opportunity to share my overall perspectives on what I'm seeing across the industry. Hey everybody, thanks for spending some time with me. And today there is not a slide on the show. Normally when I do this, I throw lots of information by way of slides, but I thought this way I do it a bit different because there are some big themes that I want to explore just in terms of what DFA does. So essentially we survey households, 52,000 each year. We survey small businesses. We run focus groups where we talk to individual households about their financial situation and their plans. And we pull information from a bunch of other areas. We put that into what's called our core market model. And that core market model is essentially a simulation of the Australian economy with a specific focus on finance and how that fades back into households. So we look at it from a household finance perspective and a SME business perspective. And that allows us then to be able to look at the data and understand what's going on and make some observations down to the postcode level, at a state and also at a national level. And we look at specifically the question of how is households travelling in terms of their debt, how they're travelling in terms of employment and their broader finances, and also we ask some qualitative questions about what they're thinking in terms of they're going to buy property, sell property, how confident are they or are they less confident, all of those things. So we try to paint a overall picture, but it's very much built from a household perspective rather than individual loan perspective or a individual loan provider perspective. So it's a very different sort of model, right? And that information then gets shared. It's shared through our YouTube channel. We make daily shows, through our blog, where we actually post a lot of our stuff on an ongoing basis, as well as doing work for specific clients, and they can get chunks of our data and use it for their own purposes. Now, there are 4 observations I want to start with. The first is that we are in the calm before the storm at the moment. So through the last few months with the crisis around the virus, of course, there have been significant government supports, Job Seeker, Job Keeper, the superannuation withdrawals, and all of those things. And yet unemployment is higher. In fact, the data's just come out today, and in August the ABS number was slightly down from last month, but the participation rate hardly moved, and there was essentially a decrease in other states, but an increase in Victoria because of all the issues with what's going on there. So no surprises there. But the point is that we are in a situation where we've got loan deferrals happening at the moment. We've got businesses that can't fail because essentially the directors can trade insolvent and all of those things. And even, of course, the banks can report bad loans as not bad loans because of the fact that they're actually deferring payments. So we're in this calm before the storm. The question we have to ask ourselves is, what does the next 6 to 12 to 18 to 24 to 36 months look like? Because if you look at past global financial crises or local crises, the event happens, but the fallout follows not just for over 3 months, 6 months, 12 months, but a number of years. Unemployment tends to rise, but then it takes a long time to come down. The question of loan defaults and mortgage defaults tend to rise, but not immediately. So we're in the calm before the storm. And now the next point to make is, and those stimulus measures that we discussed just briefly are being withdrawn. So in the last quarter, there was more than 20% of GDP by way of supports. This quarter it's 7.5%. Next quarter it's about 2% at the moment. And so we're at the time where the tide is going out, and to quote Warren Buffett, you can see you swimming naked, right? We know that later on renters are going to have to start repaying their rents. And people in rented accommodation may find that suddenly they're going to be given notice, whereas at the moment they can't be given notice. So we've got all of these fixes in place to try and keep the economy in this sort of suspended isolation, right? But the question we've got to ask ourselves is what happens when that starts to ease? And of course, the original view that the government had and the RBA had, well, this is going to be a short, sharp bounce back, bruce the other side, everything will be fine. Except that my own perspective is that the bridge is extending and extending and extending and extending. The other side looks a long way away, and I'm not quite sure what that future economic scenario is like. Now, the next point to make then is it's already hitting households. So despite all of the support mechanisms that are in place, right, we measure mortgage stress, which is essentially a cash flow view of households, money in, money out. And there are many households who are doing very well and are saving more than ever, and the savings ratio is a lot higher. But there are also a good number of households who are struggling from a cash flow perspective even now. So the mortgage stress number went up from about 32% of borrowing households to more than 40% over the last few months. And that's as high as it's ever been, and my modelling suggests it could go higher still. Now, mortgage stress is a very leading indicator of mortgage default and pain later, but it's typically 2 to 3 years early. So what I'm suggesting is that even now we already are seeing some of the first signs. I'll give you another data point. SMEs. We survey SMEs, 52,000, and about 1/3 of the SMEs that we surveyed, we asked a question specifically whether they felt they were going to be still trading in 6 months' time. And 1/3 of SMEs are saying they don't think they will be trading in 6 months' time. And you can slice and dice it by geography and by type of business, but typically smaller businesses are less confident than larger businesses. Typically, those in Victoria are the most adversely impacted, but other states are also experiencing issues. And you can slice it by industries. Tourism, of course, you'd expect that. The retail sector, yep, they're there too. And of course, things like restaurants and food and all of those areas. But there are other businesses too, the hangers-on as I call them. So for example, in the education sector, which is going through a major crunch at the moment, there are lots of small business who provide services into the education sector. And a lot of those businesses are now saying that they may well fold. And of course, there are announcements over the last couple of days of universities rolling back some of their education staff. That flows into the small business sector too. And I guess another example of that, if you go back to the consumer side, I measure financial confidence, how people are feeling about what's going on. And the confidence index is extremely low at the moment. It's actually just off its all-time lows, but only very slightly. It's well below its average. And that's another indicator that we have considerable concerns among households. So they may well be saving where they can, but they're not spending. And so if you start then painting the picture going forward, as all these stimulus opportunities get taken away, more households are going to be in more pressure. The jobs probably won't come back soon enough. More households will continue to hunker down, which means that they're going to be buying less than they have been buying, and that's going to have a negative impact on GDP. And the broader impact on mortgage portfolios and on loan balances hitting the banks has yet to be faced, because effectively we've got all of these protection mechanisms in place. So calm before the storm, and I think the storm is going to rage not for a few months, but 2 or 3 years. Well, I fear we've already gone over the cliff in central Melbourne in particular. So in my SME surveys, I'm seeing high numbers of small businesses in the CBD who are just saying it's unlikely we're going to reopen. 1/3 at least, it could be higher in some industries. And I'm also noting that my forward scenarios on home prices, I run the scenarios at a postcode level and split out houses and units. I'm seeing much more significant falls ahead in and around Melbourne CBD and beyond. I'm also seeing higher levels of mortgage stress. And mortgage stress, for example, is very, very high in and around the central parts of Melbourne and out into the outer suburban areas. But I'm giving you one example. In Melbourne postcode 3000, we have a very large number of property investors who actually hold units in Melbourne, and the vacancy rates in 3000 are very, very high. Rental stress is astronomically high. It's the highest in the country. And so we're seeing the crunch for property investors. We're seeing the crunch for mortgage holders. We're seeing the crunch for small businesses. And the point I want to make is these are all connected, right? Because essentially the person who's paying a rent in an apartment in Melbourne may be somebody who works at a small business serving coffee, who is not able to work because essentially the lockdown is there. Nobody's coming into the CBD, so they're just not, so everything's connected to this. I think we're probably past the point where the damage has been done. The question now is how quickly can it be repaired? How much support can we put in place to help businesses through the next 3, 6, 9, and 12 months? Or basically, have we, backed ourselves into a corner that we can't get out of? I hope that's not true, but I think it's very late in the piece to sort of say, you can just bounce back now. Yeah, so the mortgage stress is a lot higher in and around Melbourne. And if I take the sort of the Melbourne metro area, you can identify some hotspots. So, for example, if you go out towards Beaconsfield and some of the new developments there are huge problems there with 60 to 70 to 80% of households registering financial flow pressures even now. If you go north of Melbourne, you can see some significant areas there. If you go across to Werribee and places like that, again, the characteristic of a lot of those they are these high growth corridors, a lot of new developments done relatively recently, a lot of people highly leveraged and highly mortgaged, relying on two incomes. In some cases, just one of those incomes has basically faded away because of the lockdowns and because of the higher levels of unemployment. And the fact is that the mortgages are relatively large. So that's the first scenario. The second scenario is the unit apartment market closer in. So we're seeing quite a lot of trouble there, particularly in and around the sort of the inner suburban ring. And a lot of that is to do with younger people who've bought into these high-rise apartments, and high-rise living was lauded as being the way to do it in Melbourne, but a lot of them are struggling. And then the other point to make is a lot of property investors bought into the high-rise sector, and in some postcodes we've got 60 to 65% of property investors who are now saying, I've got a vacant property, or I'm trying to sell my investment property, or I'm having to cut my rent to the bone to try and actually make it work. And I'm also postponing my repayments, none of which, of course, is sustainable. So they're now saying, I got to sell. So pressures to sell investment properties, high-rise units close in, pressures on the outer suburban ring. And then if you overlay the SMEs on top of that, what you discover is there's a high correlation between that high mortgage stress and where SMEs are. So, for example, about a quarter of SMEs have a facility reliant on the mortgage on their property. So what you find is that some of these SMEs are now being caught up. And so again, I'm seeing very high levels. So if 1/3 is the average, in some postcodes, more than half of SMEs in a particular postcode are registering concerns. So I'll give you an example. In one or two of the postcodes there are people who provide gardening services and those sorts of things. They can't do what they are used to doing at the moment. If I look close in to some of the academic support areas, some of the people who do some of the support stuff for the academics, that's gone. Wherever you look, you can see this weird correlation between the SME sector, the stressed households, and what's going on. The final point to make here is that the other thing I'm watching is what I call structural unemployment. So in the first round, from the first lockdown, a lot of the unemployment was casuals, part-times, people just doing gig economy jobs. Now I'm seeing structural unemployment. I'm seeing consultants being laid off. I'm seeing people in the finance sector being laid off. I'm seeing people in other industries, the education sector. And these are people with big mortgages, big incomes, big lifestyles, and suddenly now they are being confronted with very significant issues. And of course, for them, the job seeker is not going to cut the mustard in terms of just keeping their lifestyle together. So the fact is that we're seeing structural issues now, and many of those people have multiple properties, including investment properties and an occupied property with a mortgage as well. And so they have really big pressures. So it's all building. And as I say, relative to the rest of the country, Melbourne is now the epicenter. Okay, so there's a few things to say there. Firstly, it depends on which indices you read, right? One of the important points to make is that the indices are reliant on transaction throughput. Transaction throughput is extremely low at the moment. In other words, price discovery is all but broken. It's absolutely broken in Melbourne. It's nearly broken elsewhere. So that's the first point. The second point is a lot of the indices are using market data last asking price rather than the settlement price, because the settlement price takes 2 to 3 to 4 months to come back into the system. And I can tell you that in many locations, settlement prices are down 10 or more percent from the asking price. And we also have a very high level of no price disclosure when transactions are done. Look at the auction reports that are there, very, very low volumes, despite the quoted high clearance rates, which we can touch on if you want, because there's some interesting anomalies there. So what I'm arguing is that the real story about house prices is not the ones being reported in the indices. And I also noted that the ABS data that came out earlier this week was a little bit more down relative to some of the other indices that are out there. And they also made the point that in a couple of markets, there's just so little transaction volume that they have to use proxy methods to try and figure out what's going on. So that's the first point. Then if I run my models, I am seeing units in some of the outer suburban areas of, say, Sydney, already down 20%. I'm seeing some houses that are also now down 15 to 20% and dropping. And they basically dropped in 2018, 2019, recovered a bit last year, and they're going down again. So I'm afraid that the average numbers that are being quoted completely hide what's really going on. There are some areas where prices are very strong, where there's limited supply. High quality houses close into the centre of town, for example, still very attractive, particularly because they can be subdivided and potentially a builder can still go and do things. But if you look at the outer suburban areas, if you look at some of the high-rise areas, I'm seeing prices significantly weaker. I'm seeing supply of new properties rising in some of those areas, although much further down in others. So the truth of what's happening with regard to property prices is not, I don't think, being publicly disclosed. I think people are being tricked into thinking that the market's, bounding forward. It's not. And of course, everybody wants the Ponzi scheme to continue. They want new buyers to come in, which is one reason why the first-time buyer incentives are there, and they want the cycle to continue. So everybody's, on the up. The truth is, the data is not actually supporting the hypothesis that it's been a strong market. Well, you have to go back to the global financial crisis, and it's worth just looking where US house prices are now relative to where they were before the global financial crisis. In many areas, they're still lower than where they were, right? So basically, they dropped dramatically, and it took quite a long time to come back. There are also, of course, some significant numbers of people buying new properties in the US and being involved in that construction cycle. We're doing the same here with the home builder stimulus packages to try and get people to buy land and home packages. My observation there, by the way, is if you go to Western Australia, there's been a huge boom in home land packages since it was announced. You can get $55,000 if you add together the state and the federal stimulus. And guess how much home land packages went up on day one? $55,000. So I'm a bit skeptical as to whether some of those incentive schemes work. And of course, the other factor we have to bear in mind is interest rates are a lot lower. So, and it's true over in the US, it's true here. And that means, of course, that people can effectively perhaps service a bigger mortgage, although there are some limitations on that. And in the US, of course, property relative to income is just so much cheaper. I mean, it's ridiculously cheap relative to here. We have some of the highest debt-to-income ratios and the highest multiples in the world. It's a world apart from the US, so there are some massive differences between the US and what's happening here. Yeah, absolutely. So it's one of the questions I've been asking since the deferral started. So I think of it like this. If I think of the total pool, and there's about 9% of mortgages that are effectively deferred at the moment, I think about a quarter of them people will come back and will start making repayments. In my surveys, there was quite a high proportion, higher than I expected, of people who just asked for the deferral even if they didn't need it. And that was because the banks did very little due diligence. It was basically, if you asked for it, you got it if you're an occupier. We know that about 34% of the deferrals were for property investors. And we know that a number of property investors basically just took the opportunity not to have to make those repayments. If you think about negative gearing and you increase the size of your loan, well, who cares? Because it's a net zero sum game. So there's about 25% who will come back, no problem. There's another 25% at the other end who are in deep doo-doo and whose income profile has completely changed from when they had their mortgage. And I see that both from the owner-occupied area, where in fact it's a jobs question, particularly two jobs going to one job, two jobs going to a part-time job, those sorts of things have made a dramatic change of income. Now, those conversations are only just starting at the moment, and as you know, some banks are being more proactive than others in having those conversations. We also know that some customers are being, what shall I say, careful not to pick up the phone when the bank rings, because they don't really want to have that discussion yet, right? So I think about a quarter will need to be restructured, will need to essentially think about making alternative arrangements. There's another 4 months, obviously, that you can do. But the banks are also, I think, from the regulator's point of view, the banks are under obligation to really try and understand these customers now. Now, that's quite difficult because about half of the customers we speak with have no idea about their financial flows because they don't run a cash flow. They've got no real sense of where their money is. They just know they've got this mortgage problem, right? So one of the things I keep saying to people is run a cash flow, understand where you are, understand what your money in, money out is. That's what we do with our mortgage stress analysis. We create mini balance sheets and cash flows for each household. But then you've got this chunk in the middle. And the chunk in the middle are the really interesting ones because they have some change to their employment. They have some prospect of potentially being able to repay the mortgage in some way, but it will require major restructuring of the loan. And that's going to be the interesting discussion as to whether, in fact, they will be able to make reduced payments. Interest only is one of the conversations I'm seeing a lot of. A lot of people are being switched back to interest-only loans. Now, you'll remember all the discussion post the Royal Commission about interest-only loans and some of the risks, and the regulators were breathing down on everybody saying that, interest-only loans are high risk. Well, guess what? The regulators are now quite happy for people to go interest-only. Anything to stop defaults, right? So that's what I'm seeing. So I think there's a runt of about 25% of those mortgage holders who potentially are going to be forced to sell. The banks are already having quite strong conversations with some of them about saying, maybe it would be a good thing to think about putting a property on the market. But the banks don't want to foreclose, but if they can encourage a troublesome borrower to sell, get out, release the equity, repay the bank, then everybody wins, right? The last thing the bank wants to do is to hold high levels of bad loans and defaults, 90-day plus, because at some point that's going to hit capital unless APRA continues to sort of just rub it out and say don't worry. And of course you may have noticed that APRA did change the rules slightly to say, well, once you've restructured it, you can basically start the count again. So there is some real room that the regulators are actually giving the banks, but I think at some point this has got to run out, right? And so the question for me is, of that 25%, how many of them ultimately will end up selling and getting out with their shirt? How many will ultimately be able to find some way of restructuring? And how many of them will turn into defaults? I think defaults will be higher. We saw some data quite recently relating to car finance, and the defaults were up there. I'm seeing some other data in some other loan categories too, where defaults are also rising. But I think this is going to be a long, slow grind. I don't expect to see the peak of defaults for the next 18 months to 2 years. And it's worth reflecting on what happened in the US, but when people stopped paying, the banks didn't immediately foreclose on them, because what they're going to do with them, lots and lots of properties that nobody wants. So there was this sort of funny middle ground for a number of years where people continued to live in the property, didn't pay, and so they sort of worked it out. And of course, ultimately, the properties were sold on cents to the dollar, and in some cases, many properties in the US were demolished because of the fact that they couldn't actually work out what else to do. Hope we don't go there. So that's how I see it too. So, there are some that are fine, but I also would agree with you that lack of transparency on this, despite what APRA has done with this sort of its pseudo reporting, is horrible. It's very difficult to read what's really going on, which is why I think our surveys are quite valuable. I think the investors are the ones that are going to be more caught, particularly young investors who maybe have, an investment property, maybe living in rented accommodation. I quite often see that because people basically couldn't buy where they wanted to buy, so they went for an investment property, often a unit that actually could well be in one of these high rises where there's cracks, where the rentals have dropped by 20 to 30% already, and where there are very high vacancy rates and very high sales, right? Now, the chances of those properties being able to be sold and actually get out scot-free is very low. So I suspect there'll be a lot of focus on that particular segment. I'm already seeing it. In fact, some of my focus groups, I've actually spoken to individual property investors who have already had the conversation with the lender about what to do. In some cases, lenders are also encouraging people to move. So particularly high loan to value exposures. A couple of people told me that they'd actually been expressly suggested that they might want to look elsewhere for their facility, because essentially this particular organisation, who I won't mention, was no longer interested in maintaining a relationship with them. So there was a sort of you got to move or else sort of story. And I think that we're going to see probably more of that. We also know that where some people have actually recommenced repayments, the term of the loan has not been changed, but the monthly repayment has increased. And I think that's quite an interesting and significant factor. We also know that some of the non-banks are being particularly aggressive at the moment and moving people onto higher rates on a risk-based pricing story. And we probably will hear more about risk-based pricing ahead, I think. And also it's worth making the point, of course, that at the moment the credit ratings of the individuals are actually not impacted by some of this, but that will no longer be the case soon. So effectively, there will be some changes, I think, based on that too. And the final point I'd make is that I'm seeing some, if you like, more generous conversations amongst some of the smaller credit unions and building societies relative to some of the larger organisations. And I think that some of the regional banks are in particularly difficult situations because of their funding models and because of their exposure to particular segments of the market. So I am seeing some differences of conversation between different types of banks to different types of customers. And I think it comes back to this fundamental question. If you are actually an owner-occupier with a reasonable amount of equity, then you can probably muddle through interest only, etc., etc. If you are somebody with a very small loan-to-value exposure, in other words, you've got 90, 95%, whatever it is, so basically there's very little equity, and you think prices are going to go as we think they probably will, the banks are being more aggressive with those particular groups. And then I think property investors in particular, particularly those with multiple properties. So there's been a lot of cross-leveraging of one investment property to the next, to the next, to the next, to the next, right? And each individual loan is separately reported in the APRA data, so nobody notices what's really going on. But if you look at it from a complete consumer perspective, you get a completely different perspective. I think some of those are going to be also under a lot of pressure. So this is a real tricky thing for the banks. Obviously, they want to try and build a positive profile out of this, given the Royal Commission. And yet, I think some of the conversations they're going to have are going to be really tricky. And like I've said earlier on, a lot of people are just ignoring the calls from the banks saying, well, we're not going to talk to the bank. So I'm not sure what happens then. Well, I think there's a couple that we should be thinking about. I mean, the first question is, obviously, we can extend and pretend for a bit longer, but at some point, the rubber has got to hit the road, and we've got to actually get back to well, what is a good loan, what is a bad loan? I've noticed that a number of lenders are already tightening their lending criteria, looking for different loan-to-value ratio settings, definitely being very selective in terms of certain types of property in certain locations. We're going to see more of that. So I think the lending processes are getting tighter even as we speak. That leaves then the runt of people who have significant pressures. Now, to my mind, there is going to have to be a question at some point as to whether we need some sort of mechanism whereby the properties that are actually now potentially underwater and with very high risk, should they be in some way created into a separate, let's call it bad bank, good bank, the old strategy? You basically give it to the Reserve Bank or somebody to look after on behalf of the banks. Because the trouble is, if you don't do that, then you've got very high provisions and very high risks inside the banks. So there may well be some sort of policy response from the regulators and the Reserve Bank if we see this running through. It's been done elsewhere, and it may make some sense. I think the final point to say is that the responsible lending provisions which were in place, ASIC's basically just rubbished and said, don't worry about it, guys, just carry on. If you can lend, no worries. At some point, we've got to get back to responsible lending multiples, right? And I keep coming back to the fact that I'm not sure that the solution to very high levels of mortgage debt is to actually make even more debt available to households and indeed businesses, right? It seems to me that we're just continuing to perpetuate the too much debt. Remember that the ratios are off the scale. From a debt to income perspective, we're the highest in the world. Debt to GDP, we're second after Switzerland. That is a big issue for me because we've distorted the housing market, we've distorted the finance system, we've got so much lending to houses from the banks. And the thing that I think is the biggest policy area is what we're going to do for small businesses. There has to be a better support package for the small businesses, the dynamo that actually creates so much activity in the economy. At the moment, JobKeeper is not cutting it. And I think I may have said, but if I haven't, I will say it now. For me, the bellwether question is not so much mortgage and mortgage repayments. That will work itself out. It's the small business sector. Small businesses look to me to be going to the wall and will be going to the wall without more tailored and targeted support. That is the number one policy area that I think we should be focusing on at the moment, because we need those small businesses. And we don't just need, frankly, more cafes and restaurants. We need businesses who can be more creative and innovative in creating new business opportunities, because we need some multiple growth capability to be able to actually take us into a new, better future for our economy. My worry is we're just going back to the same old, throwing out more debt, lending more to houses, people for houses, and essentially just hoping that somehow this will magically continue. My own view is it's time to take a deep breath and set a new trajectory, new direction, but that then takes leadership, political leadership. It takes a different perspective from the Reserve Bank. So I'm not totally confident, but that's what I'd like to see. Well, it is weird because there is more due diligence still being done, but the decisioning seems to, at the end of it, be more advantageous to the consumer, and there seems to be more willingness to write certain types of business. But it comes back to things like risk profiles and loan to value. So it is not universal, right? So if you've got very little equity in your property, and if you're basically off target with regard to some of those key metrics that people are now looking at, it's very hard to refinance. So we're getting a lot of people who are on old expensive loans who can't refinance to the new cheap ones, right? Whereas the banks are really fighting very hard for those other borrowers with a better loan to value exposure, with a better history, and with a lower risk. So I think they're shopping quite selectively, and there's a real battle, if you like, for the good business, of which there is still quite a lot, and the refinancing numbers have been quite high, as you'd expect, because people are able to get remarkably low deals at the moment in terms of the rates, and every time that they can get the rate lower, they actually end up in an advantageous position. But there is a bunch of people who I would regard as mortgage prisoners, locked on the older, more expensive rates, who are unable to refinance, who are caught with very little equity, and these are some of the very same people that are now actually under the gun in terms of the income pressures as well. So I'm beginning to see, if you like, a bifurcation in the market, and I think there's a big fight around the the good part of the market is at work. I don't see that same in the bad part. And I'd also make the point that some of those people who are struggling are the very same people who are now using buy now, pay later facilities and using other personal finance facilities to try and struggle through. And I think that it's significant that more banks have now entered the buy now, pay later market. And I think that's a very important, and I'm not sure that it's a good move insofar that it's yet another pseudo credit facility, but it's one that a lot of people are relying on at the moment. It seems to me that the LVR is the critical thing rather than the income test at the moment. Obviously, income is under pressure, and I guess they're hoping and expecting that maybe income will bounce back. If you're on a job keeper or a job seeker or whatever it is at the moment, if the prospect is that your job will come back, they are taking account of that. I do know that some are actually basing decisions on the job keeper flows themselves, which is interesting. But it looks to me quite muddy. And it does look to me as though there's quite a lot of exceptions being made relative to where we were previously. And of course, ASIC has allowed that to happen really through their change guidance in terms of the responsible lending standards. Basically, I think people are taking, what should I say, a generous risk-based profile approach at the moment, assuming that there is still equity in the property. Let's muddle through. Let's hope we can get people to the other side, and hopefully prices won't fall too far. My worry is that if in fact the bank's earlier predictions on 30%, or what CBA said 32% price falls, worst case, then a lot of this would actually go bad. So maybe the latest views as to why house prices aren't going to fall as far is one of the reasons why the banks are now doing more like this. It's certainly been sliding back if you look at the system graph. Remember, people are still repaying. One of the other interesting statistics is a lot of people are using the money that they've got from super or else to repay down, pay down debt. That's a sign of uncertainty and a sign that they want to try and protect themselves into the future. And what's interesting, if you look at the net, balances of outstanding, right? Big repayments, some refinancing and a little bit of equity withdrawal in some cases, and of course the capitalisation of the principal interest has added 2 to 3 billion to the loan balances across Australia at the moment as well. So, but the net is very, very weak, and of course business lending is even worse, right? I mean, I come back to my point about the business sector is looking pretty sick. Small business lending, particularly, is looking very weak at the moment, and that's a concern. In my modelling, I cannot see a big resurgence of credit growth. I think we're going to go sideways or down. I think that we're going to find it significantly more likely that there will be less refinancing ahead because the rates pretty much are now where they've got to. I mean, they might go sideways a bit. I think it's unlikely they'll drop much more. And of course, we are seeing in some cases some people being asked to pay a little more when they go to those new deals that are being restructured at the moment. So my own perspective is credit growth is going to remain relatively weak. That's going to mean pressure on the banks in terms of their ability to be able to actually drive profitability. Certainly my modelling is suggesting profitability is going to be an issue. Therefore, I guess that will translate to perhaps dividends as well. And the debt cycle that we have here and the rise of bad loans, which I think we're going to see, is going to come through, but it's not necessarily going to come through straight away. But the banks are going to have to actually put stuff aside relative to that later, and that will also cramp their style in some of the things that they might want to do. So, I mean, I think the banking sector overall is going to be going through a significant grind for quite some time. It depends which type of customers you're talking about. For some, absolutely. So, the meat and potato, really good loans with a lot of equity, with good incomes, that you can get massively good deals and you can shop around and you can get rates, with a 2 in front rather than a 3 in front in some cases now. That's pretty remarkable, and that's, unheard of. And I think it'll probably stay like that for quite some time. Others, much less so. Some people are having to go to the non-bank sector who are more prepared to write subprime loans or near-prime loans at a higher interest rate. We're seeing more of that now. And we're also seeing some people, these mortgage prisoners, who cannot transact and cannot find somebody to give them a better loan. So they're caught into an older loan at a higher rate and are still paying above the market. Well, the brokers, of course, are desperate for business because the volumes are way down, and so they are happy to try and facilitate and assist. My broker surveys indicate that a lot of the conversations are about helping good customers find a better loan and going with that. There have been some changes also to the fees in terms of when you refinance and the clawbacks and those things, which perhaps have changed a little bit of the dynamic there. I also note that some first-time buyers are now going to use brokers. So the first-time buyers are looking for the very best deals, and so a greater share of first-time buyer business is going via broker than previously. More than welcome, and I've enjoyed speaking with you about it. And if people want to get more, they can come to the DFA blog at digitalfinanceanalytics.com or go to the YouTube channel called Walk the World. There's a lot of information there, including lots of charts and data, and always happy to share the data, because I think the better informed we are as a country and as investors, the better everybody is.